Hey there, investors. Jim Cramer here, and let me tell you, the bond market is screaming a warning as loud as a bull on Wall Street. We're talking about long-term US Treasury bonds, folks. Those safe havens? Not so much anymore. You see, when those yields go up, the prices of existing bonds plummet. It's basic bond math, but trust me, it can seriously dent your portfolio. We're in a rising interest rate environment, folks, and that's bad news for long-term bondholders. This isn't the time to be complacent. This is the time to act. Stay with me and I'll break it down for you. Now, why are these rising yields such a big deal? Simple, they have a profound impact on your investments, especially bonds. When you buy a bond, you're essentially lending money to the government or a corporation. It's a loan, and in return, they promise you fixed interest payments over a set period. These interest payments are supposed to be your steady income, a reliable source of returns. But here's the kicker. When interest rates rise in the broader market, those fixed payments on your long-term bonds become less attractive. Imagine this. You locked in a bond at a 2% interest rate for 30 years. Suddenly, new bonds are being issued at 4% or even 5%. Your 2% bond doesn't look so good anymore, does it? Think about it. Would you rather lock in a low interest rate for decades when you could get a much higher return elsewhere? The answer is obvious, of course not. And guess what? Neither would any other savvy investor. They'd all flock to the higher yielding bonds, leaving your low yield bond in the dust. That's why, as yields rise, the prices of existing bonds fall. It's a basic principle of supply and demand. It's all about supply and demand, folks. And right now, the demand for low-yielding long-term bonds is drying up faster than a puddle in the desert. Investors are seeking better opportunities, and that leaves your bond portfolio in a precarious position. So what can you do? Diversify your investments, stay informed, and always be ready to adapt to changing market conditions. Your financial future depends on it. Now, I know what you might be thinking, but Jim, everyone's talking about a soft landing for the economy. Surely the Fed will start cutting rates soon, right? Well, hold your horses. Don't be fooled by the hype. Sure, the market is hoping for a scenario where inflation cools down without a major recession. But let's be real, folks, the risks are real. The economy is a complex beast, and there are no guarantees. Inflation is still stickier than flypaper, and the Fed is laser-focused on bringing it down. They have a mandate to control inflation, and they won't hesitate to act. That means more interest rate hikes are likely on the horizon. Higher rates can slow down economic growth, but the Fed believes it's necessary to keep inflation in check. And you know what that means for your long-term bonds? Higher interest rates can lead to lower bond prices, affecting your investments. You got it, even lower prices. So stay informed and be cautious. The financial landscape is ever-changing, and it's crucial to stay ahead of the curve. Now, I get it. Some of you are holding on to those long-term bonds, praying that the Fed will pivot and start cutting rates. You're hoping to ride out the storm and come out ahead. But let me tell you, that's a dangerous game to play. First off, timing the market is about as reliable as a weather forecast a month out. Second, even if the Fed does eventually cut rates, it won't happen overnight. And in the meantime, you're stuck with those low-yielding bonds while inflation eats away at your returns. Trust me, folks. Hoping for a Fed bailout is not a solid investment strategy. Section 5, short-term bonds, your safe haven in the storm. So what's a savvy investor to do in this treacherous bond market? Well, let's talk about a more sensible approach. Short-term bonds. Think of them as your all-weather portfolio protectors. They offer a couple of key advantages in this environment. First, their shorter maturities mean they're less sensitive to interest rate changes. Second, they give you more flexibility. As rates rise, you can reinvest your money more quickly into higher-yielding options. Remember, folks, in investing, it's not always about hitting home runs. Sometimes the smartest move is to play it safe and protect your capital. Section 6, diversification is key. Explore other avenues. Now, I'm not saying you should dump all your long-term bonds and go all in on short-term debt. Diversification is still crucial, folks, but it's time to explore other investment avenues that can offer better risk-adjusted returns in this environment. Think about it. The stock market, while volatile, still holds opportunities for growth. Real estate, with its tangible assets, can be a good hedge against inflation. And let's not forget about alternative investments like commodities or private equity. The key is to spread your risk and not put all your eggs in one basket. Section 7, don't be a sitting duck. Time to sell those long-term treasuries. Look, I know it's tough to say goodbye to investments you've held for a long time, especially those considered safe like US Treasury bonds. These bonds have been a cornerstone of many portfolios, providing a sense of security and stability over the years. But remember, folks, the market doesn't care about your feelings. It operates on cold, hard facts and ever-changing dynamics. Emotional attachment to investments can cloud your judgment and hinder your financial growth. It's all about adapting to the changing tides. Just like a sailor must adjust their sails to navigate through a storm, you too must be ready to make strategic moves in response to market shifts. Holding on to those long-term bonds in a rising interest rate environment is like clinging to a sinking ship. The value of these bonds decreases as interest rates rise, eroding your investment. You might hope for a miracle rescue, but it's time to face reality and jump ship before it's too late. Waiting too long could result in significant losses that could have been avoided with timely action. Don't be a sitting duck. In the financial world, passivity can be costly. Staying informed and proactive is key to safeguarding your investments. Take control of your financial future and consider selling those long-term treasuries while you still have the chance. Consult with your financial advisor, review your portfolio, and make the necessary adjustments to stay afloat in these turbulent times. Section 8. Subscribe for more market-moving insights. And there you have it, folks. The bond market is a tricky beast, but with the right knowledge and a proactive approach, you can navigate it successfully. Remember, staying informed is crucial in the ever-changing world of finance. So hit that subscribe button below to stay ahead of the curve and get more market-moving insights from yours truly, Jim Cramer.